So in this ratio analysis, we'll compare one figure with another figure, and we'll compare 1 year information with other information. So we'll compute different ratios. So simply if we look at the financial statements like balance sheet, P&L and notes, so a lot of information we may not be able to extract from that, right? So we may not be able to decide if any decisions needs to be made. So basing on that P&L and balance sheet, so we will compute some ratios which indicates some weaknesses or strength regarding affairs of the company. So broad categories of ratios are, we have 5 different categories of ratios: profitability and return, long-term solvency and stability, short-term solvency and liquidity. Profitability and return. Profitability is nothing but these ratios are mainly with profits. Long-term solvency and stability, mainly about our capital structure, share capital, borrowings. Short-term solvency and liquidity. These ratios are about liquidity, cash, immediate, how much availability of cash is there. Efficiency. These are about turnover ratios. And shareholders' investment ratios. So how much return shareholders will get out of their investment. So the ratios are classified into these 5 categories. So first let us look at profitability and return ratios. First ratio is return on capital employed. So ROCE, we will term it as a ROCE shortcut, return on capital employed. So what is this ratio? Capital employed. So capital employed means what? So what are the source of finance? How the business is being funded? So business will be funded either in the form of capital or in the form of borrowings, right? So capital employed is nothing but shareholders' equity plus non-current liabilities. Non-current liabilities means long-term borrowings, right? So these are the capital employed. So capital being infused by the outsiders. Shareholders are outsiders. So we have to take shareholder equity. Shareholder equity is nothing but share capital plus reserves. So reserves are also the form part of owner's equity. So we have to take share capital and reserves plus non-current liabilities, long-term borrowings. Non-current liabilities means long-term borrowings. So these are capital employed. This, how much profits the company is being earned out of this capital employed. So formula for that is PBIT by total assets less current liabilities. PBIT, profit before interest and tax, by total assets less current liabilities multiplied by 100%. So what does it mean? So these shareholders plus long-term borrowings means the fund investors. They expect some return, right? Return from the company. That return will nothing but profit. Profit after distributing that profit, the whatever income, after deducting that income, all the expenses from that income, will arrive at some profit. But the profit we have to take before interest and tax. Why? The interest is nothing but the interest we pay to non-current liability holders, long-term borrowings, right? So to arrive this ratio, so we have to exclude interest and tax. So we have to take profit before interest and tax, PBIT. So PBIT by total assets less current liabilities. Capital employed can be either equity plus non-current liabilities, or we can take assets less current liabilities. Both are same. Assets less current liabilities is nothing but shareholder equity plus non-current liabilities. So this is one of the important ratio, return on capital employed. So shareholders and other lenders will know about how much percentage of return they are getting out of profits of the company. For suppose if we have funds, what we can do with the funds? We can invest in a bank. So bank will give some interest, 6% or 7%. Or we can invest in other borrowings or other properties, right? So we can earn some percentage, right? 7% or 8%. But if we invest in a company, how much we are earning? That is called ROCE, return on capital employed. Return that we are getting out of our investment, right? This is useful to compare from 1 year to next year. Ratios we can compare, and we can compare this rows with the rows earned by other company, right? And we can compare this percentage with current market borrowing rates. That means if in the market, if we lend these funds, how much return we get. For example, in outside market, if we are getting 6% return, and if in a company the ROEs percentage is 8%, that means our investment is earning better return, right? If in market the rate is 10%, but in a company we are earning only 8%. That means our investment, we are not able to earn sufficient return by comparing with the external market borrowing rate. So this ratio can be analyzed in these ways. So very important ratio. So what is the formula? PBIT by capital employed. Nothing but PBIT by total assets minus current liabilities, or equity plus non-current liabilities. So both we can take. Next, return on equity. So this is not being used by most of the companies, because for equity we have lot of other ratios. So here return on equity, that means how much equity shareholders are getting out of the profits earned by the company. This is nothing but PAT, profit after tax and preference dividend, because entire profit is not available for the shareholders, right? So equity shareholders will get only after distributing to the preference shareholders, right? So we have to deduct, we have to take PAT and preference dividend. So profit after tax and dividend, the final profit that is available to the equity shareholders. And how much is that percentage? Simple ratio, profit after tax and preference dividend divided by equity shareholders funds multiplied by 100%. This is return on equity. So how much return is being earned by equity shareholders? The previous formula is return on capital employed. Capital employed means equity shareholders plus borrowers, long-term borrowings. So both we will take. So that is the reason why for ROEs we take profit before interest, because interest is being paid to long-term borrowing holders, right? So that is the reason why for ROEs we take PBIT, profit before interest and tax. But for return on equity, we will take profit after tax and preference dividend. So this is one of the ratio, return on equity. Next. So this capital employed, so we have just now seen about this ROEs formula, return on capital employed. So this we can interpret in two ways with respect to sales. So that we are going to discuss now. So very important. If you see here the formula, this ROEs can be split into two formulas, profit margin and asset turnover. So what is this? So profit margin, that means out of our sales, total sales, how much profit a company is earning, PBIT by sales. This is nothing but profit margin. This profit margin also, we have two types of profit margins, gross profit margin and net profit margin. That we will see in later slides. But here we are computing net profit margin, like net profit margin, but before interest and tax. So out of the sales, how much is the profit percentage? That is profit margin, PBIT by sales. And out of the capital employed, that means out of the funds infused into the company, how much sales are being generated by the company. That means we have some assets minus current liabilities, or we have capital employed. So out of this money, how much sales are be able to be generated by the company. So if these are the two factors that we have to take into consideration while evaluating ROEs. So simply comparing ROEs will not give a correct picture. So we have to evaluate ROEs with respect to profit margin and asset turnover. So let us look all these theories into with one example so that we can understand it in a better way. Suppose ROEs of a company for 20x8 is 35.7%. and for 20x7 previous year. So previous year return on capital employed is 32.1%. That means what we can analyze from these two percentages, in the current year, the company's ROEs percentage is high. That means company is performing well. and shareholders are getting good return out of their investment, right? That is called ROS. So in current year, the percentage is better than previous year. And this percentage we have split into two categories. How much is the profit margin and how much is the asset turnover. So in 20 profit margin is 11.64% and asset turnover is 3.7 times. What does it mean? 3.07 times. That means out of our capital employed, out of our total assets, using those assets, company is generating a lot of revenue. 3 times means better revenue, right? So suppose if we have 300 turnover and 100 is the capital employed or net assets, right? 300 by 100, 3 times. That means out of the 100 investment, company is able to generate 300 sales, right? Better sales 3 times. So that means company is using the assets in a better way. And if you look at this profit margin, so previous year we have good margin, but current year the margin is less, right? So what could be the reason? Here if you see the sales are very high. If you see the asset turnover, the sales are high compared to previous year. Why? Because the asset turnover is high. Asset turnover is high means we have a lot of sales using the assets, but the profit margin is low, right? What is the reason for that? What could be the reason for that, right? So this could be the reason for fall in profit margin. Of course, there is no much more fall in profit margin. The fall is very little, but the reason is we have improved our sales, right? Though we have improved our sales, sale prices have been decreased to some extent. So that is the strategy of the company, maybe the strategy of the company, because to improve the sales, to increase the sales, so company has to compromise on selling rates. So because of that reason, there is a little fall in profit margin, but the asset turnover is very good. So we have increased our sales a lot of time, more than one time we have increased the sales. That is a good signal, right? So, but we have to analyze in the other way also. Profit margin, decrease in profit margin is due to decrease in sale rates. Increase in turnover, right? Here that turnover was increased. Increase in turnover could also be a reason for, there is a reason for decrease in rates. But increase in turnover means there is a huge market base because a lot of customers are there, customer base is there. That is also a good sign, right? This is how we have to analyze this rows. So simply seeing at rows 35.7 and 32.7, we can't say that. So there is an increase in percentage, that means company is performing well, right? Yes, there is an increase in rows percentage, but the reason is increase is due to high sales, but low sale rates. So high sales means there is a high customer base. So a lot of new customers might have added. That is a good sign to the company, right? This is how we have to analyze. So rows has to be split between profit margin and asset turnover, and we have to analyze the ratio. So whatever we have discussed, we have this in this example. So if you see here, company A and company B, PBIT is same. That is profit before tax is same, before interest and tax is same, and capital employed is also same. But if you see here, sales revenue, sales of company is 10 lakhs, but sales of company B is 40 lakhs. Though there is a huge increase in sales, right? So there is almost 30% increase in sales. Not even 30%, 300 times, right? 300 times increase in sale is there. But though there is huge increase in sales, the profit is same. Why the profit is same? Because though we have increased our revenue, we have reduced the selling rates, right? Or we have incurred huge marketing expenditure, right? So that is the reason why there is the profit before PBIT is similar, though there is a hike in the sales revenue. That is how we have discussed in this solution also. If you see here, ROCE is same, 20% and 20% for company A and company B. But look at the profit margin. Profit margin is 20% for company A, but company B profit margin is only 5%. That means what happened here, what could have happened here? There could be a decrease in selling rates, sale prices have been fallen, or we have spent a lot of money expenditure to improve the sales, lot of advertisement expenditure, or hiring a lot of employees, marketing employees to improve the sales. So here the profit margin is little, only 5%. But asset turnover is good in company B, right? We have our capital employees did 10 lakhs, but 4 times we have increased our sales, right? Though asset turnover is 4 times increase positive, but profit margin is decreased, right? This is how we have to analyze. Simply we can't say that company A and company B are same, right? By just looking at this rows percentage, we can conclude that company A and company B are same. No, company A and company B are not at all same. Company B is in huge risk because customers are used to have less selling rates. But company A, if it puts some efforts to increase the sales with the same level of selling rate, company A will perform very well, right? So this is how we have to analyze. So we have to look at the question and we have to compute the rows, but rows itself will not give us the interpretation. So rows has to further split into profit margin and asset turnover, right? So this is what I have given. High profit margin could be due to high sale price, low sales revenue. Company A is the example for that. High asset turnover due to lot of sales but lower rates. Company B is an example for that, right? So this is ROCE, very important ratio. So definitely in an examination, ROCE is a very important ratio. Return on equity, we may not get questions on return on equity, but ROCE is a very important ratio. Now, GP margin, NP margin and profit analysis. This we all know about this. Gross profit margin. Gross profit by sales into 100. Net profit margin. Net profit by sales into 100. Right? And profit analysis. How to analyze this? So we have an example, year 1 and year 2. If you see here, net profit margin. First look at net profit margin. Year 1. Net profit margin is nothing but 7,000 by 70,000, 10%, right? And year 2, 10,000 divided by 1 lakh, 10%. So if you see here, net profit is same for both the years, right? But GP margin, so how much is the gross profit margin? Gross profit margin is nothing but GP by sales, 28,000 by 70,000, it is coming to 40% for year 1. And year 2 it is coming to 45%. What happened here? Though gross profit margin has improved in year 2, net profit margin is same because of increasing expenditure. So if you see here, the expenditure was 21,000 for year 1 but 35,000 for year 2. Due to this increase in expenditure, but here if you see, year 2 is better. Right? Why year 2 is better? It has increased its sales and it also increased its margin also, gross profit margin. That means there is an increase in sales volume. Also there is an increase in selling rates. Right? So that is the reason why there is a gross profit, good GP margin is there, but still net profit margin is not improved due to huge expenditure. If company is able to decrease this expenditure, other expenses, because other expenses are in our control, right? So we may take efforts to increase these other expenses. If we can make efforts to decrease the expenditure. If we decrease this expenditure, then year 2 is very good, right? So this is how we have to analyze. Complete net margin will not give a true picture. So net margin, if even if net margin is same, here we came to conclusion that gross profit has been improved, but similarly they have increased the expenses from year 1 to year 2, right? So what suggestion we can give? We can give a suggestion that company should make efforts to decrease the other expenses, because other expenses are in our hand. So but sales are not in our hand. So sales, selling rates, and having new customer is very difficult, right? But the better suggestion is reduce the expenditure, then year 2 will be better. In future also company can perform well if the expenditure is in control. This is what the profit analysis, profit margin and net profit margin and gross profit margin. So this is about profitability ratios. So we have 5 types of ratios, right? So profitability and return ratios we have completed. Profitability is nothing but GP margin and net B margin. Return ratios. Return ratios means return on capital employed. How much return are being earned by shareholders and lenders of long-term borrowings. And return on equity. So how much being return earned by equity shareholders. We have 2 ratios for return, ROCE and ROE, and for profitability we have 2 ratios, GP margin and NP margin. Now coming to long-term solvency ratios. Long-term solvency ratios are nothing but long term, we look into long term and short term both. So very important ratios. First, let us discuss about debt ratio. Debt ratio is nothing but total debt by total assets, right? So these ratios are generally useful to bankers because they are the one who lend the money to the company, right? Who will give the money to the company. So company will have debt from banks only. So these ratios are useful for banks. So so we will compare our debt with total assets, right? So ratio is total debt by total assets. If debt ratio is high, that means what? We have huge debt, but we have less assets or less profits. Assets is nothing but non-current assets plus current assets, right? Debt is nothing but total payable. So we have to consider long-term borrowings, short-term borrowings, current liabilities, whatever within payable within 1 year, more than one. Total debts. Total debts means total liabilities, total payables to outsiders. Total debt we have to take, and total assets. Total assets means non-current assets plus current assets. Simply total assets is nothing but asset balance sheet total. Asset side of balance sheet total, we have to take total assets. And for total debt, so excluding equity capital and excluding that retained earnings, all other liabilities, because all are payable, maybe within 1 year now or maybe after 1 year. Suppose long-term borrowings are there that are payable after 1 year or after 10 years. That also we have to consider here, right? So 50% debt ratio is safe ratio. But if we have more than 50% means that is risky. But of course, this analysis also depends upon the situation. Companies having higher debt may operate successfully also, right? Why? Because some of the companies may value non-current assets at lower value. Some of the companies may value non-current assets at higher value, at revaluation would be there. So if the assets are undervalued, in such a case, debt ratio will be more. But we can't say that since debt ratio is more, the company is in risky position, right? So this is how we have to compare. 1 minute. Yeah. So this is how we have to compute the debt ratio. So this is not the only indicator to judge the performance of the company, right? So even if the debt ratio is more, the company can perform well. Next important ratios, gearing ratios and leverage ratio. So these are purely about capital structure. So capital structure, so source of funds. So in a company, what are the sources of funds? How we will get the money? Money will be from either from issue of share capital, or from borrowings, interest bearing borrowings, right? So we, in these gearing and leverage ratios, we will compute the share of equity in total structure and share of interest bearing debt in total structure. So I'll give an example. Suppose company is having 40%, 40 as equity and 60 as debt. How much is the total capital structure? Total capital structure is 100. So out of this 100, equity shareholders are holding 40%, right? And the debt holders, debt is 60%. This debt 60% is called gearing ratio and 40% equity holding is called leverage ratio, right? Gearing ratio is with respect to debt, leverage ratio is with respect to shareholders holding. Shareholders holding is nothing but share capital plus reserves. Both we have to consider. So this we have to assume. So whenever I say shareholder equity means it includes it not only the share capital. So we have to take share capital plus reserves because or equity shareholders are owners of these reserves also. Reserves also belongs to equity shareholders, right? So in our example, 40% is leverage ratio. That means 40% is belongs to, out of total capital structure, 40% is belongs to shareholders. And out of the total capital structure, 60% belongs to debt holders. That is called leverage and gearing ratio. So what is more better? Having high leverage percentage is better or having low gearing percentage is better? Good one. See, high gearing is always risk, right? High gearing means what? We have high debts in a company. So there is a fixed obligation for the company for payment of interest. Irrespective of profits, company has to pay interest. So that is why high gearing is always risky. High leverage is not risky. Of course, we should have a balanced structure, but coming to risk part, having high leverage is not a risky because we have more shareholders funds and more profits on hand, and payment of dividend is not a obligation, right? It is not an obligation, and there is no obligation for repayment of equity also, right? Equity will be paid only at the when liquidation of the company, but that is not the case in case of interest bearing debt. So we have to pay fixed amount of interest every year, that is the outflow, and we also have to repay the bank borrowing, so that is also an obligation. So high gearing is always risky. So having high leverage is also not good. We should have some portion of debt and some portion of equity, but more than 50% leverage ratio is good. So that is how we have to analyze. So in an examination questions, they will give leverage ratio of 30. So that means automatically how much is the gearing ratio? 70. So we may have to compute some gearing ratios and some other ratios. But gearing, so if we have gearing ratio, that means we always have leverage ratio on hand. Gearing 30 means leverage 70. Gearing 60 means leverage is 40. So this is the concept of gearing and leverage ratio, very important. So these ratios are particularly with respect to capital structure, long-term ratios. So capital structure comprising of equity and debt. How much is the equity portion is leverage ratio. How much is the debt portion is gearing ratio. Right? So if we have high gearing ratio, then if banks may also think to give the money to the company. So it may not be possible to have the money if company wants to expand its business, and if gearing ratio is high, banks may not fund to the company, and the option is we have to improve our leverage ratio. That means company has to go for fresh issue of shares. So to have this type of analysis also, these ratios are important, gearing and leverage ratios. So if leverage ratio is high means if leverage ratio is high and company needs funds, so what it can do, it can approach to the banks and it can get money from the banks. That is the option. If gearing ratio is very high, that means banks may not give funds to the company, and what is the option available? So company may go for fresh issue of shares so that it will improve its leverage ratio. So to take such kind of decisions also, these ratios are very important. So this is the formula for leverage ratio. Leverage ratio is nothing but equity by total structure. Nothing but equity by equity plus debt. Gearing ratio is nothing but debt by equity plus debt. So this we are comparing debt portion with total capital structure is called gearing ratio. And here equity portion comparing with total capital structure is called leverage ratio. Leverage ratio, one of the terminology for leverage ratio is equity to assets ratio. Right? So this is the concept of gearing and leverage ratio. So we have an example here. So look at this example, company A. Company A equity is 900. Equity is nothing but shares plus reserves. 900. B equity is 700. C equity, company C equity is 600. That means there is a decrease in equity component, right? So company C has less equity component, and coming to redeemable preference shares and loans, these are borrowings. Even redeemable preference shares is also not a share capital. Only non-redeemable share capital is a form part of equity, but redeemable share capital will not form part of equity. So we know, right, redeemable and non-redeemable share capital. Redeemable preference share capital means we have to repay the share capital after 5 years depending upon the terms of agreement. Non-redeemable means these are like equity shareholders. So once they have infused this preference share capital, we will not redeem this share capital, but they will get fixed percentage of dividend compared to equity shareholders. So we have share capital, redeemable preference share capital and borrowings. If you see company A has only 100 debt, company B has 300, it increased by 200%. Company C has 400 debt, right? So company C has more debt. So if you see here, capital employed is same for all the three companies. Capital employed is same, 1000, 1000 and 1000. But there is a changes in the structure. Capital structure of the company is different. Some companies are having more debt and less equity, and company A is having more equity, less debt. Company C is having more debt compared to company A and has less equity compared to company A. So here we have these ratios. See, look at the gearing ratio. Gearing ratio of company is only 10% because gearing ratio is what? Debt proportion. Compare with total capital employed. Here debt proportion is how much? 100 out of total capital employed of 1000. 100 divided by 1000, nothing but 10%. 10% is gearing ratio. That means 90% is leverage ratio. So company A is mostly depends on their share capital. So company A is not depending upon debt from outside parties. So coming to company B, its gearing ratio is 30, leverage ratio is 70. That means company B is also depending upon leverage equity, but it also has balanced thing. It also has some proportion of debt, 30%. And company C is also more balanced. So gearing ratio is 40 and leverage ratio is 60. That means it is getting funds from fresh issue of shares and it is also getting funds from borrowings. But share of equity is more than share of debt. That is always preferable. So this is how we have to analyze, and this we also have to analyze with respect to profits. Why? Because gearing ratio means, so there is a compulsory obligation for repayment of interest, right? So if we should have sufficient profits to discharge that interest. So that is the reason why we have to compare PBIT, profit before interest and tax. That means how much profit being earned by the company, and is it available for payment of interest or not. That we have to analyze. So let us look at another important example. Take the same example of company ABC, but we are looking into profits of these companies. If you see PBIT, PBIT of three companies is same, 50, 50, 50. So profits before interest and tax is same. That means we have similar profit for both the companies, but company C has, if you see here, company C has more gearing, right? 10% is for company A, 30% is for company B, and 40% is for company C. So company C has more gearing. That means company C has an obligation to pay more interest or more preference dividend. That means out of total profits, more amount is going towards repayment of interest and dividend. So that is what happened here. So if you see here, company A obligation to pay to the debt holders and preference holders is only 10. And for company B, 30. And for company C, 36. Right? Though company has earned a profit of 50, 36 is payable to interest holders and means debt holders and preferential holders. Right? So how much is the balance left in company C? Only 14 is left in company C. Right? But in company B, 20 is left, and in company A, 40 is left. So here in company C, less amount is available to the equity shareholders compared to company A and B. That means company is spending, so out of its profits, company is spending most of the amount to discharge its interest obligation and preference dividend to the redeemable preference shareholder. This is a cash outflow, right? So this is how we have to analyze. High gearing means less amount of profit will be available to equity shareholders, and high gearing means there is a liquidity crunch because there is a huge cash outflow, right? But if we have high leverage means we have more profits, but it is the option of the company to distribute these profits as a dividend or not. So it may distribute dividend or it may not distribute dividend. That is the option of the company. But in case of gearing, so that is a mandatory obligation. So gearing funds, these interest bearing funds and preference dividend the company has to pay irrespective of the profits earned by the company. So that is the reason why gearing ratio more than 50% is good. So this is the concept of gearing and leverage ratios. Next ratio is interest cover. So whatever we have discussed, that is the same logic applicable for interest cover. Interest cover means what? So what is the availability of profits to cover interest, right? That means whether the company is able to earn sufficient profits and whether these profits are available to discharge the interest obligation. That is called interest cover. Whether company is earning profits that are at least be covered to pay the interest. The formula is PBIT by interest. We'll compare our interest obligation with our profits and we'll see how much we are having. So an interest cover of 2 times or less would be low. So interest cover of 2 times. So take some example. Suppose we have profits of 100 and interest of 50, right? That means 2 times profits are available, right? So 2 times of profits are available to discharge the interest. We have 100 profit and our interest is 50. That means how much is the interest cover? 2 times. That means we have earned 2 times of profits compared to interest. Right? 2 times we have earned the profit. Right? If we have less than 2 times, that means we are in risk. Though there is no little profit available to the equity shareholders. Though we may be able to discharge the interest, but there is a very little profit available to the shareholders. So this is not the guide, but this is the acceptable limit. 2 times or 3 times is the acceptable limit. If we have less than 2 times or less than 1 time means, though we have sufficient profit, but we are earning profit only to discharge interest charge. But we should earn some profit to give dividend to the shareholders and to retain some of the profits for future uncertainties. Right? So that is the reason why 2 times or more than 2 times or 3 times is better gap, better limit to judge company whether company is having better interest cover or not. This is called interest cover. So PBIT by interest. Very simple ratio. So we have an example for this interest cover. So if you see here, company A, company B, company C, when we have a PBIT of 50,000, company A has interest cover of 5 times. Very good. Company B has 1.67 times. Company C has 1.39 times. So if you see here, profit are available. Profit is available to discharge the interest. But how many times it is there? So company A has 5 times. That means what? It is very good, because after paying this interest, company is left with 4 times of profit. So 5 times means 1 time is going to interest, to discharge the interest. The balance 40,000 is available for equity shareholders. Equity shareholders means whether we may pay dividend, but we may not pay dividend. But we have good amount of retained earnings in our balance sheet, so that we can use for future growth of the company. So company B has 1.67 times, that is 20,000 out of 50,000, 30,000 is payable towards interest, only 20,000 is left. In company C, 36,000 is the interest, that means only 14,000 is left. Right? This is how we have to analyze. So this gearing, leverage and interest cover ratios, these 3 ratios are linked. So we are moving to next ratio called cash flow ratio. This is a separate ratio. So this will compare, that means this will compare how much cash being generated by the company out of its operations. So cash flow from operations. So how we will get this number? This number we will get from cash flow statement. So we know how much cash flows are being generated from operations. That we will compare with our liabilities, total debts. So total debt means we will take total short term and long term. So if in an examination, if they have not given any long term liabilities, then we have to compare this with short term. So this is as per the exam question, but generally the ratio is net cash flow by total debt. So if in an examination we have been given with both short term and long term debt, we have to take total debts. So if in an examination if they give only cash flow ratio with respect to current liabilities, then we have to consider net cash flow from operations divided by current liabilities. If an examiner requires cash flow ratio with respect to total debt, then net cash flow from operations divided by total debt. So we can use these two formulas to arrive at this cash flow ratio. It depends upon the examination question. The next important ratios are short-term ratios. So far we have discussed about long-term ratios, gearing ratio, leverage ratio and interest cover ratio. Now we are going to discuss about solvency ratio, short-term solvencies and liquidity ratios. So to understand these ratios, we should know the operating cycle of the company, because these short-term solvency and liquidity are mostly with respect to cash generation in a company. The long-term ratios that we have discussed earlier is about only capital structure. How well the company is having debt, how well the company is having equity, how the funds are getting into the company, right? but the most important ratio is this liquidity ratios, right? How the company is able to get the cash, because that is how the company's operations will run. Company's operations will not depend upon the only on the capital structure. That is only a 10% issue. The capital and debt is only that we will take only at the time of incorporation of the company and to have capital thing. But the most important ratios are solvency ratios, right? So let us look at operating cycle of the company, how the cash will be generated in the company. First, the company will buy the raw material, right? It has to purchase the raw material. For that, it needs the cash, and it has to pay for the raw material, that is the cash outflow, right? So it will procure the inventory, it will manufacture the inventory, and if it is in the inventory in the books, less cash realization. If it don't have inventory, means it will sell the goods in the market. If it sell the goods in the market, we'll get the money back. That is called operating cycle. Spending the money and getting back the money from the market. This is called operating cycle. So cash element is involved in this operating cycle, right? So operating cycle of the company, in some cases, operating cycle could be 30 days, or in some companies it would be 100 days or 120 days or 300 days. We'll discuss how to compute this operating cycle. So this operating cycle is mainly depends upon account payable. Account payable means payable to suppliers, and inventory. So how long we are holding the inventory, and collection. How quickly or how long company is taking to collect the money from the market. So this operating cycle depends upon these three factors, right? And liquidity. What is liquidity? Liquidity is nothing but immediate availability of cash. Immediate means quick availability. Maybe immediate means cash is immediate availability. And we may have investment, short-term investments and trade receivables. They are also immediately available, not within one day, maybe within 1 or 2 months, immediate availability. That is called liquid funds. So here there is a definition given for liquid funds. Liquid funds consist of cash, which is immediately available, and short-term investments, for which also there is a ready market. So this is also immediately available, and deposits with high interest and readily available for withdrawal. That is also a liquid fund. And trade receivables, of course, debtors is a liquid fund. Debtors may have a credit period of 30 days or maximum 40-45 days. So within those days, we can collect these funds. This is also a liquid fund. Cash will be rotated through collection from debtors. Bills of exchange. So similarly, similar kind of debtors, there will be a bill of exchange. That is also a short-term liquid fund. So if you see these are nothing but our current assets, right? Cash, debtors, short-term investments, these are nothing but current assets. But here we don't have inventory, right? So inventory means company may have short-term inventory. That means the inventory that can be disposed within 1 month, or it may have inventory that can be disposed after 1 year or 2 years, right? So we may compute these liquidity ratios by including inventory or by excluding inventory. And cash cycle, this is what we have discussed. So one of the most liquidity ratio that we use is current ratio. What is current ratio? Current assets by current liabilities. What is current asset? That is what we have discussed. Current assets means liquid assets. Cash, debtors, and other short-term investments, and inventories. So if we take inventories, that is called current ratio. If we exclude inventory, that is called quick ratio. So it depends upon the question in examination. So you may require to compute either current ratio or quick ratio. So in current ratio, we take total current assets including inventory. In quick ratio, we will take current assets excluding inventory. So that is the numerator, current assets, divided by current liabilities. Current liabilities, we know creditors and other outstanding liabilities, current liabilities, trade payables and other outstanding liabilities, right? So what is the safe ratio? Current ratio in excess of 1 is safe ratio, of course, right? So we should have balance current assets and current liabilities. So excess of 1 is always good. Quick ratio. Quick ratio may not demand for excess of 1, at least 1. At least 1 is good, because in quick ratio we are deducting inventories. We are not considering the inventories, but we will get money from sale of inventory also, right? Current ratio in excess of 1 is preferable. Quick ratio of minimum 1 is preferable. But these 1 or minimum 1 are not the factors, so we have to look into the type of industry also. Take an example of supermarket, right? In case of supermarket, they don't have much receivables, right? Because they will sell in cash, right, in supermarket, but they will have more payables. Why? Supermarkets will buy the goods in bulk, so they may take credit period of 30 days or 35 days, but they may have less receivables, because supermarkets will not sell on a credit basis, they will sell on a cash basis. So if they sell on a cash basis, they may spend that cash on other investments. They may buy a properties, right? So in such a case, they will have less current assets. They don't have much cash. Though they get more cash, they might have spent that cash in other activities of investment activity, right? Trade receivable is low, because supermarkets will sell only on cash basis. Credit will be very low, right? They don't have higher inventories also, because supermarkets goods are very perishable in nature, right? So looking at this in view of perishability, their inventory is also not high compared to manufacturing industries. So in such a case, their current assets are low, but they have huge current liabilities, trade payable, because they will buy the goods on a credit basis. So in such a case, their current ratio would be less than 1 also. It doesn't mean that supermarket is having crunch of liquidity. No, that is not the case. It is having good liquidity position. That is the reason why the benchmark 1 and less than 1 is there, but that is not that scenario. We have to compare with respect to type of industry, right? In case of manufacturing industry, they'll keep huge inventories on hand. Suppose if raw material prices are decreased very low, then what they'll do, they'll buy huge raw materials and they'll manufacture, and they'll kept in inventory, and they'll store the goods in a godown. Why? Because the raw material prices are low, their cost of goods will be low. Their inventory cost is low. They can sell these goods at a higher profit margin. In such a case, current ratio, of course, will be less. So this current ratio we have to judge based on the performance of the company, and nature of the industry is the first criteria, and the situations why current ratio is low. If whatever situation that I have discussed, manufacturing industry, keeping high inventories because of higher production is because of lower rates of raw materials, is a good sign, because they have huge demand, but they have produced more goods meeting demand for future 2 years because of these lower rates for raw materials. This is how we have to judge in case of a current ratios and quick ratio. So this is about current ratio and quick ratio. And next important ratios are about operating cycle that we have discussed. So how much time we are taking to pay to the trade payables, how much time we are taking to get the money from the debtors, and at how many days we are keeping inventory in our godown, inventory holding, how many days we are keeping our inventory. These three decides about our operating cycle. Our operating cycle will be decided by these three factors. First, let us look about accounts receivable collection period, debtors collection period. Debtors collection period, that means length of time taken by the debtors to pay their dues. That means how much time debtors have taken to repay their dues. So they may repay within 30 days or within 40 days or within 90 days, within 100 days. So that time we have to compare. because that is where we'll get the money. That is the time by which we'll collect our receivables. That is also form part of our operating cycle. How much time we are taking to collect the receivables from the market. That is called debtors collection period. Formula is debtors by sales. Trade receivables by sales. Here sales means we have to take credit sales because debtors will form part of credit sales, right? So cash sales, there is nothing to compare cash sales with trade receivables. So in an examination, if they give credit sales, we have to take credit sales. So if that information is not available, then we have to take total sales. So debtors by sales into 365. So we'll get collection period. So how much time where company is taking to get the money from the debtors. This is called debtors collection period. So we have an example here. Look at, we have three different types of companies. One is supermarket, other one is manufacturer, other one is other sugar seller. For a supermarket, collection period is 6.4 days because supermarket sells only on a cash basis. Very little debtors will be there, right? For a manufacturer, the collection period is 80 days. For sugar refiner and seller, the collection period is 29 days. Right? If you see here, it's a general practice actually. It doesn't mean that manufacturing company is not performing well, right? Because it is the nature of the industry. It's the nature of the supermarket. The period is 6 days is acceptable, and for a manufacturer, collection period of 80 days is acceptable. Maybe we can reduce this 80 to 70 or 60 or 40, but it is never possible to reduce this 80 to 6 days like a supermarket, because that nature of industry and this nature of industry is different. So this we have to consider while analyzing or while comparing the collection period between one company to another company and between one period to another period, right? So the other ratio is period is inventory turnover period. This is also form part of operating cycle. Number of days that items of inventory are held. So how many days we are keeping our inventory in a company, right? So if we are keeping our inventory for 30 days, that means we are taking 30 days to sell the inventory in the market. Only if we sell the inventory, we'll get the money from the debtors. This is called operating cycle. So the formula is take stock by cost of sales into 365 days. So we'll compare this inventory with, actually we have to compare this inventory with purchases, right? Because inventory is nothing but our purchase cost plus production cost. So for inventory turnover period, ratio is inventory by cost of sales. So generally inventory we have to compare with purchase cost, right? Because that is for which we have to pay money to outsiders. So if purchase information is not given in the financials, we can take cost of sales. Inventory by cost of sales into 365 days. So high inventory period means what? We are keeping our inventory for a long time in a company. Low turnover period. So low turnover means here this collection period. Low collection period means we are able to get money quickly from the market, but we are keeping our inventory for a longer time. So that is how we have to analyze. This is called inventory turnover period. The next ratio is payable period. So as I told, we have to consider payable and inventory and receivable. So payable means what? How much time company is taking for making payments to suppliers. So how do we compute that? Trade payable, creditors by purchases. So we'll purchase goods from the creditors. So payable by purchases into 365 days. Now, so simple ratios. Payable means payable by purchases. Receivable period means receivable by sales. Inventory turnover means inventory by cost of sales into 365. We have to compute these three periods in the form of days. So we have to multiply this fraction into 365 days. So here we'll get the operating cycle. What is this operating cycle? Inventory turnover period plus account payable period minus account payable period. Sorry, here accounts receivable period. So inventory turnover plus account receivables period minus account payable period is called operating cycle. So that is operating cycle. Inventory turnover period. So how much time it is taking for inventory. And accounts receivable period. So how much time company is taking to get the money back. Minus account payable payment period. That means only when we have the money, we should be able to pay to the suppliers. So that period we have to minus, we will get the operating cycle. So this is about operating cycles, efficiency. So these are very important ratios: inventory turnover, account receivable and account payable ratios. Next ratios are about shareholders investment ratios. These are very simple ratios. These we all know about this. Shareholders investment ratios means what? So shareholders will invest in the form of shares. Per share, how much the investors are able to get. So for which we have 4-5 ratios. First ratio, very popular ratio, is EPS. So we all know about this EPS, earning per share. So total profit after interest, after preference dividend, how much profit is available to equity shareholders. That total profit divided by equity shares. So for this we might have seen a lot of exercises: equity shares, convertible shares, how to do, diluted EPS, how to do, outstanding if we have shares in the middle of the year, how to do this. We have already discussed in earning per share chapter. So here we are discussing the formula for this. EPS is nothing but profit, net profit by equity shares. So we will get earnings per share. So how much earning is available for each share, right? But the total earning will not be given by the company as a dividend, right? So it will retain some part as retained earnings and it will distribute only some part as dividend. So but how much dividend earned is called dividend per share. Very simple. Here we take total dividend by total shares, because total net profit will not be distributed as a dividend, right? And net profit also we compare only for the year net profit. This we will add to retained earnings and company will decide based on the retained earnings position. Company will decide how much dividend has to be paid to the shareholders. So EPS is one form and DPS, dividend per share. This is also very simple, total dividend by shares. That means per share how much dividend the ordinary shareholder is getting. Next, dividend cover. This is also like interest cover. How our earnings are sufficient to discharge the dividend. EPS by DPS. Very simple ratio, dividend cover. So EPS by DPS. That means out of this EPS, how much is the dividend cover? How much dividend we are paying to the shareholders? Suppose if earnings are 100, dividend is 50. That means 2 times earnings are available. That is a good sign. But we are paying only 50% as a dividend. Balance 50 we will kept as a retained earnings. So to know that position, this dividend cover is useful. So dividend cover of less than 1% means what? Company is paying huge dividend. Though earnings are less for the current year, company is paying huge dividend out of previous year earnings. So to analyze this kind of situation, so we have to compute this ratio also, dividend cover ratio. So this is about EPS, DPS, and EPS by DPS is dividend cover. And the next important ratio is PE ratio. So this will compare with outside market rate. PE ratio is nothing but current share price, current market share price by EPS. So that means we'll compare our EPS with market price of the share. Current share price. Share price we will get from the market stock exchanges. This price will be available. So that current share price we'll compare with EPS, whether we are getting good earning in the share price, market share price, not the face value of share price. So we'll take market share price and we'll compare that with our EPS, whether are we able to earning sufficient earning out of this share price. If we are not earning, we can sell the shares in the market. They will get huge market price from the outside if we sell the share. So to analyze those kind of suggestions, we have to compute this PE ratio. How is our EPS compared with market share price? Very important ratio. So this ratio will be used by all the companies. PE ratio is such an important ratio, will be used by all the companies. EPS and PE ratio are important ratios. Dividend ratio, companies may not be useful, this dividend ratio, but EPS and PE are very important ratios to shareholders. And dividend yield, simple. So how much percentage, dividend yield means that we compare in the form of percentage. How much percentage of dividend we are getting comparing with market price of the share. Dividend on the share divided by market value of the share. So how much yield we are generating from out of the market share. That is called dividend yield. So these are the ratios with respect to shareholders, and this account payable, account receivable, and inventories are ratios about efficiency of the company. So if company is having a operating cycle of 300 days, that means it is taking lot of time to have this operating cycle. If company has an operating cycle of 100 days, it is a good sign. So this is also about efficiency of the company. Efficiency of the company is being determined by the operating cycle. And short-term liquidity ratio means it also includes current ratio. We looked at current ratio and quick ratio, right? And we have also looked about gearing leverage concept, and then GP/NP margins, and then return on equity and return on capital employed. So these are all the ratios. In our next session,